Welcome to Fundamental Analysis. In this lesson, you will be learning about economic data and reports and which of those reports are the most important ones to focus on. Along with that, other market moving forces. You will learn how these fundamentals affect stock prices and how you can expand your trading opportunities. So let's get into it. What is fundamental analysis? To put it simply, it's another way to research and analyze markets using economic data with social and political events and news and other market moving forces. Larger geopolitical events like war and Brexit do play a role as well. The key here is to identify these market moving events and be aware of them while we're trading. These events can be traded themselves, which we will get into a little bit later on. So why use it? Why even take the time to learn about these fundamentals? You can show me a chart with your favorite setup, a beautiful falling wedge pattern on the daily chart, prices approaching the top trend line, it's about to break out with increasing volume, your MACD, RSI are giving you the buy signal, your moving averages are lining up perfectly, everything looks good. This is going to break out. Well, a single fundamental catalyst can completely change your technical setup if you got caught off guard by it. For the better or for the worse, right? You can still profit on it, but you wouldn't have that uncertainty if you were aware of that setup. What the fuck do I keep saying setup, bro? So why use it? Why even take the time to learn about these fundamentals? You can show me a chart with your favorite setup. A beautiful falling wedge pattern on the daily chart. Prices approaching the breakout point at the top trend line with increasing volume. Your MACD, RSI are giving you the buy signal. Your moving averages are lining up perfectly. This is going to break out soon. I mean, everything is on point. Well, a single fundamental catalyst can completely change your technical setup for the better or for the worse, but being aware of that upcoming event could save you from a potential rug pull. But I'm not here to argue whether fundamentals are better than technicals. That's not the case at all. The goal here is to combine technicals with fundamentals to find those best trades, those A-plus setups that will make you money and help you lose less of it. Remember, we don't get paid for how many times we trade. We get paid for our ability to find the highest quality trades and repeating that. Now, one thing to always remember when it comes to fundamentals and analyzing these events is that the market has a very short-term memory. So let's get into these sources here, right? I like using Trading Economics. I really like investing.com, MarketWatch, CNBC for daily news and updates, Twitter news. Highly recommend you follow these couple people here that I have listed, and many others, right? But it's so convenient to have data and news pop up on my notifications, and I can make trades based off of that. The breaking news app as well is very effective. One reason I really like using investing.com is because if you can come up here, find the economic calendar, you'll click on that. The filter feature, you can select your country. I'm in the US, I selected that. You can select the level of importance of the events that you want to look for, right? 1 to 3 stars here, 3 being the most important. But what I really like is that you can select the category here, right? Let's say, for example, you want to look at employment, the category. It'll show you all these 1, 2, and 3 star reports and data that can give you a nice visual of how the overall economy is doing in that specific sector category, which I think is really cool. All right, let's get into the actual economic data. Which of these reports are the most important ones we should focus on? So like I mentioned earlier, there's many different types, many different categories, and using the economic calendar, we will be focusing on those tier 3 events, those 3-star events. So we have here labor market, job market reports, inflation reports, economic output, business and consumer sentiments, and the Federal Reserve. For the labor market, this just gives you a month-to-month measurement as to how the job market is looking. An increase in jobs means a stronger economy because economic output can rise and add to an overall increase in GDP. Higher jobs reports in turn makes it more attractive to invest in the economy and invest in the currency, which ultimately strengthens the dollar. On the flip side, bad jobs numbers can make it less attractive to invest in the economy and the currency, which ends up weakening the dollar. The most important jobs reports you want to look out for: JOLTS job openings, ADP employment, non-farm payrolls, and your unemployment rate. Next up, we have inflation, which is the overall rise in prices in goods and services over a period of time. Now, inflation has been a hot topic these past couple years, 2020, 2021, 2022. Inflation is supposed to be actively monitored by central banks. If they do decide that the economy needs more inflation, they will increase the money supply, which is what happened during 2020. If the economy has too much inflation, they will decrease the money supply. Inflation is not always a bad thing. The Federal Reserve was once targeting a 2% annual rate, which is moderate and healthy. Think about it. A gradual increase in prices means that there is business competition and consumer demand continues to grow, which in turn means the economy grows. Too much inflation is a problem. It can end up lowering consumer confidence and consumer spending, which lowers retail sales and overall GDP. We'll get more into how the Fed operates in a separate lesson, but the most important inflation indicators you want to watch out for: consumer price index, producer price index, and personal consumption expenditure. Next, we have economic output reports, which are reports that measure the amount of goods and services a nation creates over a period of time. These are all important data points, but the most market moving ones are going to be your GDP and your retail sales. Then we have business and consumer confidence, which is pretty straightforward. Monthly reports that measures how consumers and businesses are feeling about the economy. These can be used as a leading indicator for GDP and retail sales. The most important ones are going to be your consumer confidence and your personal spending. Last but not least, we have the Federal Reserve. And like I mentioned earlier, we're going to go more in depth into this topic later on in another lesson. But the most important Fed reports, data that you want to watch out for, are going to be those FOMC meetings, those interest rate decisions, your FOMC minutes, and some Fed member speeches. Like, for example, if the chairman, Jerome Powell, is speaking. All of these events are extremely market moving, and you want to know when they are happening so that you don't get caught off guard. Now that we know the important events and what they measure, let's look at which areas of the market get affected. We have here the currency, ETFs, bonds, sectors, and individual stocks. Each economic category affects different areas of the market. The labor market is going to affect the dollar, ETFs such as SPY and the Dow, and bonds, TNX. Economic output data, specifically the manufacturing data, is going to affect the Dow Jones Industrial and the currency. GDP is going to affect bonds, currency, and ETFs. Retail sales are going to be affecting those retail sector stocks and ETFs, along with SPY as well. That inflation data is going to be affecting tech stocks, bonds, other ETFs, and the currency. The business and consumer sentiment reports are going to be affecting the currency and ETFs. More specifically, the personal spending reports are going to be affecting those retail sectors and ETFs. And the Federal Reserve affects all currency, all bonds, all stocks, everything. The one constant that always gets affected by all these data points is going to be the dollar. When you're looking at the dollar's chart, fundamentally a stronger dollar means increased purchasing power and affects the profits of US companies that export internationally. It makes doing business more expensive and makes importing cheaper since the value of the dollar increases against other currencies. A weaker dollar means lower purchasing power, and US companies that import materials can see a rise in costs, while making exporting cheaper since the value of the dollar drops. When you convert that from a stronger currency, you get more dollars in return. Now, some keys for the dollar here is that the market mostly does not like a stronger dollar. A weaker dollar could be an indication that stocks are about to move higher. A stronger dollar, you should expect it to put pressure on equities and growth in tech names and push commodities and energy stocks lower. A weaker dollar, you should expect that to relieve pressure on equities and growth names and push commodities and energy stocks up. Now, one thing to understand is that the effect is not always immediate. When you're seeing the dollar go down, it's not an immediate reaction that the market is going to start moving higher. These are longer term, more macro indicators. So we need to be mentally prepared for that when we're looking at these charts. But you do want to look for divergences. For example, if the dollar is going up while stocks are going up, the dollar is likely to continue, right? That's a divergence there. If you have the dollar going down as stocks go down, you could expect stocks to likely bounce up. With this being said, you cannot just look at the dollar by itself to form a full analysis. You need to combine it with the bonds to get the bigger picture. So what are bonds? They are debt units for investors to get a guaranteed fixed return. If you own shares of a company, you are an owner. If you buy bonds in a company, you are a loaner. You're lending the company money and they're paying you an interest on that. They're sold by governments and corporations to fund their operations. The ones we're going to be focusing on are the US bonds, which are issued by the federal government through bond auctions. There are three types: savings bonds, which are 20 to 30 years, T-notes, which are 2 to 10 year expirations, and T-bills, which are a few days to a few months expiration. The difference is in that expiration, the maturity, and the interest payments. Those longer term maturity bonds, like the savings bonds, have a higher interest payment because you're locking in your money for 20, 30 years. Because bonds have the full backing of the US government, they are known as safe investments. Here's a quick little example. If you buy a 10-year T-note at a yield of, let's say, 1.9%, you will get 1.9% interest on your money invested twice a year until that note expires. So why do we look at the debt market? The debt market is much, much larger than the stock market. Everyone uses debt. Foreign and larger investors can park huge amounts of money in for a safe return. And when you're looking at the bonds, they can be used as an indicator as to how the economy is looking. Some keys for bonds is that a bond's return is measured as the yield. So when you're looking at the charts on bonds, the price action moves inversely to the yield. So when price action is going up, investors are selling bonds. When price action is going down, investors are buying bonds. When bonds are selling off, fundamentally that means that investors are more bullish on the economy and pricing in future rate hikes from the Federal Reserve. Money that flows out of the debt market can go to the stock market or other risky investments. If you have bonds rallying, that could mean fundamentally investors are leaning more bearish on the economy and money is flowing into these safer investments. With this, money can flow out of the stock market. Sometimes it depends on the market context. But as traders, we do want to look at the 10-year yield, TNX. It is a treasury note that can be used as a longer term investor sentiment indicator. Now, some combinations that you want to look for when it comes to the dollar and the bonds to figure out what markets are going to do is dollar going up, bonds going up. This is a clear-cut indicator that you may see a move lower on ETFs, techs, commodities, oil, overall equities lower. If you have the dollar down and the bonds down at the same time, really good indicator that you'll see a move up on ETFs, oil, commodities, tech stocks, equities. If you have the dollar up while the bonds are down, that's a divergence. The equities can still move up, but be on the lookout for a move lower when that divergence plays out. Another divergence is the dollar down with the bonds up, right? Equities could still move lower at this time, but be prepared for a move up, a bounce higher. If you have the dollar down or up, doesn't matter, but the bonds are stable, you can see a move up on equities. If you have the dollar stable and the bonds are stable, that's a very nice equilibrium zone to be in. You should expect equities to move higher on this. Another important fundamental you want to look at is going to be crude oil. And you want to look at the reports that come off for crude oil, one of them being the OPEC meeting. OPEC is a group of 13 of the largest 13 oil producing nations, and they decide oil production, supply, and the price. They hold monthly meetings to come to decisions on these matters. Along with that, you have monthly oil reports such as U.S. crude oil inventories. Oil likes war and conflict. It moves higher on this type of news. For example, I mean, very recently, early 2022, you have Russia and Ukraine conflict that's really helping oil and energy to move up higher here. Some keys for crude oil is that understand what oil does for the market. Two of the largest sectors of the stock market are the energy sector and the financial sectors. So these two are heavily affected by the price of crude oil. Banks are heavily invested in crude oil. So when that goes up, it can bring up the overall market with it.